AI stocks are hot, but the useful investor question is not whether artificial intelligence will matter. It almost certainly will matter in many industries. The practical question is whether the company you are buying can turn that broad technology story into measurable revenue, durable margins, free cash flow, and a defensible advantage. A trend can be real while a stock is still overpriced. This episode is educational only. It is not a recommendation to buy, sell, hold, or avoid any stock, fund, or sector. We will use 5 questions to separate company profits from market narrative. The first question is whether AI demand is visible in the company financials. Press releases, conference buzz, investor decks, and repeated use of the letters A and I are not enough. Look for orders that convert into revenue, customers that renew, usage that expands, and products that solve expensive problems. If management says AI often but cannot identify which product line, which customer group, or which business model benefits, the company may be standing near the theme rather than earning from the theme. The second question is whether revenue can become profit. AI businesses can require expensive chips, cloud capacity, engineers, data, electricity, security, sales teams, and constant research spending. Revenue growth does not automatically become shareholder. Watch gross margin, operating margin, capital expenditure, stock-based compensation, dilution, and free cash flow. If each extra dollar of sales requires even more capital and the company has no path to operating leverage, the story may be exciting while the economics remain weak. The third question is valuation. A strong company can still be a poor investment when the entry price assumes a perfect future. AI stocks often rise because the market pulls many years of expected growth into today's price. Then, a small disappointment can matter. Slower customer adoption, lower margins, delayed orders, higher rates, new competition, or a weaker spending cycle. Valuation does not require false precision. It requires asking whether the current price still makes sense if the next 3 years are good but not perfect. The fourth question is portfolio concentration. Many investors think they are diversified because they own several tickers. In reality, they may own semiconductor companies, cloud platforms, software vendors, data center suppliers, power equipment, and technology funds that all depend on the same AI capital spending story. When the narrative is strong, that feels diversified. When the market questions spending, returns, or valuation, those positions can fall together. Diversification is not different names. Diversification is different risk sources. The fifth question is the rule before the emotion arrives. Theme stocks can damage discipline because every rally makes the story feel more obvious, and every decline tempts the investor to prove they were right by adding more. A household should decide position limits before buying. What is the maximum single stock exposure? What is the maximum theme exposure? What happens if the position doubles? What happens if the business thesis weakens? Which money is never used to chase the theme? Rebalancing is not prediction. It is protection against narrative taking control. These 5 questions change the discussion. AI investing is not rejected, and it is not blindly accepted. It is translated into evidence, revenue evidence, profit evidence, valuation evidence, portfolio evidence, and behavior rules. If a company has no financial evidence, or has sales without profit, or has profit at an extreme price, or creates too much concentration, the issue is not whether AI is important. The issue is whether the investment decision is complete enough for household money. The AI supply chain also has layers. Upstream companies may sell chips, equipment, or networking. Middle layers may provide cloud infrastructure and data centers. Application companies may sell software, automation, analytics, or consumer tools. Each layer has different margins, bargaining power, and competitive pressure. Strong demand in one layer does not guarantee high profits in every layer. Treating all AI exposure as one asset can hide very different business models. Another trap is confusing product excitement with a moat. A demo can be impressive. User growth can be fast. Media attention can be intense. None of that automatically proves pricing power, switching costs, data advantage, distribution control, or durable cost advantage. A mode is tested by whether customers stay, whether competitors can copy the feature, whether the company can charge enough, and whether the product becomes more valuable with scale. Without those elements, popularity can fade faster than shareholder returns arrive. Investors should avoid drawing a straight line from macro trend to individual stock outcome. AI may improve productivity across the economy, but the benefits can flow to customers, workers, platform owners, chip suppliers, cloud providers, startups, or consumers. The company in your account may capture only a small part of the value. Many major technology waves were real, yet the earliest and loudest stocks were not always the long-term winners. A trend begins research. It does not finish the investment case. If you already own AI-themed positions, run a stress test. What if valuation multiples fall 30%? What if spending growth slows next year? What if a large customer delays orders? What if gross margin falls because competitors catch up? What if interest rates stay higher and investors demand more current profit? If the thesis works only when every assumption is perfect, you may own a perfect story stock rather than a resilient business. For a household portfolio, AI exposure belongs inside a risk budget, not inside a belief system. Core money serves retirement, education, housing, emergency reserves, insurance needs, and long-term diversified investing. It can be researched and used, but it should have a size limit. A mature investor can believe AI is important while also refusing to let one theme dominate family finances. Imagination is useful. Boundaries make imagination survivable. Information quality matters as well. AI narratives move quickly through social media, newsletters, interviews, and short videos. Some sources are thoughtful, others are marketing, referral traffic, or momentum chasing. Before relying on a claim, ask who benefits if you trade, whether the argument includes failure cases, whether the data is current, and whether the conclusion still makes sense without a rising chart. If the source is really promotion, the risk is not only market risk, it is decision environment risk. Accounting quality should not be ignored. Some companies benefit from real demand but report results with heavy adjustments, large stock compensation, acquisition effects, or one-time items. A headline profit number may not equal cash that belongs to owners. Compare adjusted earnings with free cash flow. Look at dilution. Look at whether revenue is recurring or one-time. Look at customer concentration. AI excitement should not exempt a company from basic financial statement discipline. The same logic applies to funds and ETFs. A thematic fund may sound diversified, but the top holdings may overlap with the same mega-cap technology names already owned in a broad index fund. Fees may be higher. Turnover may be higher. The theme label may give the impression of precision while the actual portfolio simply increases exposure to expensive stocks. Before buying a fund, check holdings, weights, fees, overlap, and whether it solves a real allocation problem. The practical checklist is simple. Column 1, where does AI enter the financial statements? Column 2, how does revenue become profit and cash? Column 3, how much optimism is already in the price? Column 4, what other positions in the portfolio depend on the same narrative? Column 5, what is the maximum size and rebalancing rule? If those 5 columns are blank, the investor is not allocating yet. They are reacting to a story. The conclusion is balanced. AI can be a real economic force, and some companies may build strong businesses around it. But real technology does not remove valuation risk, execution risk, competition risk, or concentration risk. The better question is not, will AI be big? The better question is, what exactly am I buying? What evidence supports it? What price am I paying? And what rule keeps this from overwhelming the plan? This content is educational commentary, not investment advice. Household finance needs evidence, sizing, and boundaries. One more discipline is to compare the AI position with alternatives. If the same dollar could reduce expensive debt, build emergency reserves, improve retirement contributions, or buy a broad diversified fund, the theme position has to earn its place. Opportunity cost is part of risk. A popular stock can feel urgent, but household money usually has several jobs competing for attention. The right question is not only whether the AI idea is attractive, it is whether this is the best use of risk capital after the basic financial plan is funded. Finally, write the rule down before opening the trade ticket. A written rule is not glamorous, but it protects the investor from the emotional force of a fast market. If the position exceeds the limit, rebalance. If the business thesis breaks, review it. If the only reason to hold is that the story is popular, slow down. In a theme as powerful as AI, discipline matters more, not less. Another useful question is who ultimately pays for AI capital spending. When cloud companies, data centers, chip suppliers, and enterprise customers all invest at the same time, upstream revenue can look very strong. But the cycle still needs end customers to earn a return. If businesses cannot use AI to increase revenue, reduce costs, improve retention, or create better products, future spending can slow. Investors should not look only at current orders. They should ask whether the customer return on investment is becoming visible. It also helps to separate AI stocks into buckets. One bucket contains profitable platform or infrastructure companies with established advantages but possibly high valuations. A second bucket contains suppliers tied to equipment cycles, where demand can be powerful but cyclical. A third bucket contains companies with exciting AI language but limited financial proof. These buckets should not receive the same position size. The more a stock depends on future narrative rather than current economics, the smaller and more rule-bound the position should be. Time horizon matters. A short-term trade has different evidence and exit rules from a long-term allocation. If an investor says the position is long-term but changes the thesis after every headline, the plan is not really long-term. If an investor says it is only a small experiment but keeps adding after every decline, it is no longer an experiment. Clear labels protect behavior.